Here's everything you need to know about personal finance in one single video. Hi, welcome to episode 6 of Backs of All Trades podcast. Today I'm going to be talking about personal finance. 3 years ago, I was pretty much completely financially illiterate. This isn't taught in schools and it isn't taught anywhere that you would learn it, just throughout your day-to-day life. So I had to do this research all on my own. By the way, I did this all online, all on YouTube, but I'm sort of congregating all the information here. All of the content here is going to be based on the United States of America. I know that a couple of my viewers are in countries around the world. Usually there's the versions of whatever I'm talking about in your respective countries, but because I live in the United States, I'm going to be talking about this through an American lens. By the way, this is not financial advice. I am not a financial advisor, so do not take what I'm saying as financial advice. This is purely me talking about my own personal experiences through personal financial literacy, and hopefully can be more of an education. So let's get right into it, right? The first thing I want to talk about really is investing, because I think that investing is complicated. I don't think it's taught anywhere. And it's arguably what everyone's told is the best thing to do with your money. Everyone says, why would you put money in a mattress, right? If you can invest it instead. And yet no one is really taught how to invest. So this is going to be like a 101 level course here, really, right? So when we talk about investing, you can invest into a number of different assets, but the one I'm going to be talking about here are called stocks, right? Everybody's heard the term stocks. What actually is a stock? Well, a stock is a piece of ownership of a publicly traded company, meaning you actually own a very, very small piece of a pie that is the company. So if you buy a share of Apple, you now own a small piece of Apple. And if Apple as a company does well, and the evaluation of the company goes up, then your share price goes up, right? So that's what a stock is. And when you invest in stocks, you do so through a brokerage, which I'll talk about in a second. But essentially, stocks have historically been one of the best ways to make money in America. This is how the rich get richer. And it's even how most people will become, people who become millionaires, most of them do it through the stock market. And it's over a very long period of time. It's not a quick get rich quick scheme by any means. But when we talk about like retirement accounts and everything, it's the reason they can get to millions and millions of dollars by the time people retire is because stocks go up over time and compounding growth. But what's crazy is that 39% of Americans actually aren't even involved in the stock market at all, meaning they don't have any money in the stock market. So that's almost, half, more than a third of Americans aren't receiving this beautiful thing that is just stocks, right? So, or income from stocks. So when you're actually deciding to invest in stocks, there's a couple of different ways you can do it, right? There's individual stocks, which is what I just mentioned in the case of Apple. If you say, I want to go buy a share of Apple, that's buying an individual stock of Apple. Then there's things where I'm going to group them all together. They're a little bit different, but mutual funds, index funds, and ETFs, right? Essentially what these are is a basket of stocks, meaning that you have, if I put $100 into SPY, which is essentially a index fund that tracks the 500 largest companies in the United States, then that $100 is split across the 500 largest companies, and it's based on the valuation of those companies. So for example, if I put $100 in SPY, a certain amount of it will go to Apple, Google, etc. And then what's really cool about these is that it limits your exposure to individual companies. So when you invest in an index fund, then you are essentially buying a little piece of a bunch of different companies. And the example I like to use here is with Tesla, right? Tesla is a stock that has had a massive amount of growth over the past 5-10 years, right? Except it is very correlated with Elon Musk's public image. It can literally change based on how he tweets. And so that's a lot of exposure to a single thing. And so if there's a PR scandal and you're very heavily weighted in Tesla, then you can lose a bunch of money really quickly. Whereas if you just have a bunch of different companies under a single investment, right, which would be like an index fund, then you can reduce your exposure or risk to a single thing like that. That generally means that you won't see as high growth, right? You're not going to get 10,000x as if you were to go in penny stocks, but it's a lot more consistent. And when I talk about investing for the long term, which is what I personally do, that's what it is. I want something that's going to stably grow over a long, like decades, rather than something that might 100x or might go to zero, which is why I personally don't invest into individual stocks. I used to do this, and this was when I was, learning about investing and everything. And I actually got on Robinhood, and I ended up buying a couple $1,000s worth of a stock called Allbirds. It was a direct-to-consumer shoe company. And, I thought, it's going to do well. And a couple of my buddies, we thought we were doing DD, which means due diligence, that it was a good company. And it turns out that was wrong. And now I basically lost a couple $1,000s on a single shoe stock, right? So that's why I don't recommend going into individual stocks. Something like 90% of people who pick individual stocks lose money. And it's even worse if you actually talk about day trading. So I want to make it very clear when I talk about investing, especially in the stock market, that is entirely separate from day trading. Day trading is essentially trying to buy and sell stocks or options, which I'm not going to go into. That's a bit more advanced in this video. I'm not going to talk about that. But you're trying to buy and sell stocks on a very short time frame, on the order of like days or even hours, to try and make a profit. So if something is at $100 and then it goes up to $101, then you sell, you made $1 profit, right? I'm against that because what a lot of people don't realize is that when you are day trading, somebody is on the other side of that trade. You are essentially competing with somebody, and you are saying, I think that it's going to go up, or I think it's going to go down. And the other person on the other side of that trade is saying, I think you're wrong. And when you're just an average Joe Schmo doing that, then you're competing against companies that have billions and billions of dollars. That is literally their only job, is to try and beat people like you or predict the market. And they have PhDs in math. They have trading algorithms that are way more advanced than you can do. And so I always find it funny when people talk about like day trading courses and stuff. And it's just, it's David versus Goliath. I'm picking Goliath in this case because, you're not going to outsmart those people. I personally don't day trade. Again, this is not financial advice, but it's just too risky for me. And when we talk about like preparing for your long-term future for my retirement and stuff, definitely want something that's a bit more stable, right? There's something as well called being priced in, which is essentially that the stock market itself, when you look at a stock price, you might see like a news headline, right? Oh, this company has a PR scandal, for example, right? The current stock price already has that information and it's priced in. You are not going to be privy to information that the people who are essentially determining the price of that stock aren't. I don't care if you get a TikTok tip or you see an article or your buddy tells you something, oh, this company is going to do this because of that. All of that is already in the current stock price. And so basically you're not going to have information that the people with billions and billions of dollars don't. So really what you should be investing for, and what I invest for, is, okay, do I think that this is a good company that will grow over tens of years? And I don't even invest in individual stocks. So what I'm betting on is that, do I think the US economy will go up over the course of 10, 20, 30 years? And of course, that historically has always been true. That's the safest bet. So when you're talking about like the S&P 500, which just means, again, the 500 largest companies in the United States, there are index funds that track it, like SPY, which I mentioned, and they have never lost money over a 20-year rolling period since its inception. Meaning, if I buy a stock today, 20 years from now, unless something catastrophic goes wrong, I will not have lost money. It will have gained value over time. And actually, it's pretty good. So there's another thing called dividends. Dividends are essentially, some companies will pay out dividends to their stakeholders, which means if I buy a stock, Coca-Cola, for example, has dividends. They can do two types of things with their profits. They can either reinvest those profits back into the business, or they can return it to their shareholders as sort of an incentive and saying, hey, thanks for believing in the company. And a lot of companies will pay out dividends. So you can either reinvest those dividends. They literally come as basically just money into your account. And then you can either choose to reinvest those dividends or just say, hey, give me the money that my stocks are paying me, kind of like passive income, if you want to call it that. And if you reinvest your dividends, over the S&P 500, it has averaged around like a 10 point something % rate of return every year, which is crazy. Now, it's important to note that it doesn't return 10% every single year, but it has returned an average of 10% over the entire lifetime. Some years, right, if you talk about like a recession, it may drop 40, 50%, which is obviously catastrophic if you're trying to retire right then. But that's why you build in other sort of risk toleration factors. But there's a saying that you don't try and time the market. You have time in the market, right? It's time in the market, not timing the market is actually how the phrase goes. Because a lot of people will try and say, oh, but now it's a low, so I'm going to wait until it hits the bottom and then I'm going to buy. And then when it hits the top, I'm going to sell. You cannot predict the lows and the highs. Nobody can, right? Otherwise you'd be able to make an infinite money printing machine. So what's better is just to throw in money. And this is what I do, forget about it. And then over time, watch as it grows. And when it goes down, right, don't freak out, don't panic, right? A lot of people get emotional and, oh, my investments are dropping. I'm going to sell my stocks, blah, blah, blah. And don't do that, right? Or at least I don't do that because, again, none of this is financial advice. I don't know how many times I have to say that. But essentially, when the time horizon that you can have is 10, 20, 30, 40 years, then those little valleys, if you look at a graph of the S&P 500, which we can put up, those little valleys are actually insignificant in the grand scheme of things. So how do you actually invest in the stock market, right? This is one thing where I think a lot of people aren't really taught this. It's actually quite simple. There's a couple really big brokerages, and I'm not going to tell you which one to use. A lot of people ask, oh, what's the best one? What's the best one? Really, they're all good, right? They all have their pluses and negatives. But the really, really big ones are Fidelity, TD Ameritrade, Charles Schwab. And so what you'll do is you'll just go to one of those sites and say, hey, I want to open up an account, open up an investment account. And there's different types of accounts that you can actually open up to investment. So I'm going to talk first about retirement accounts, because I think this is where most people, in my opinion, this is what I focus on funding first, because it's sort of the safety net, right? And there's a couple of kinds in the United States. The most popular ones are the 401k. 401k is offered to you by an employer, and it is essentially a way for you to contribute towards your retirement, either pre or post-tax. And they will actually, a lot of companies will match up to a certain percentage of your salary. So how does this work? Well, if my company matches 5% of my salary, that means for every dollar I contribute up to 5% of my salary, my company will put an additional dollar into my retirement account. Now, that is 100% rate of return immediately. So this is a really, really good thing. And all the retirement accounts I'm about to mention have a limit to what you can contribute at a government level. In general, as a rule of thumb, if the government is capping what you can contribute to something, that means they know it's very powerful. And usually it's for tax incentivized things. And so it's a really good idea to contribute towards your 401k. A lot of people talk about, oh, but I can't touch the money until I'm 59 and a half, which is true without penalty. But the odds that you're going to be above, like you're going to live to your 50s and 60s is literally north of 80%. It's actually closer to 90%. You have almost a 90% chance to still be alive when you're 59 and a half, and you could start pulling out money. And so you owe it to your future self. If you do this right, you could have millions and millions of dollars in your 401k. Anyways, so contribute up to the match is what I do personally. And that's one type of retirement account. In a 401k, you typically have less options to choose between the stuff you invest in. So usually in 401ks, you cannot pick individual stocks. Usually you pick a set list of funds that they offer as part of that employer with your trading platform or whatever it is. And that's one type of retirement account. It goes directly with your employer. The other types are called IRAs, which literally stands for individual retirement accounts. And then there's a Roth IRA. I'll explain the difference in a second. But individual retirement accounts, both Roth and IRA, you can just open one, right, with virtually any platform. And what's really cool about these is that, again, there's a set contribution limit. And so in 2023, it's $6,500, meaning that the max you can contribute is $6,500. And then In an IRA, what you can do is it's tax deductible, meaning if I contribute $6,500 into an IRA, then I can subtract that amount from my taxable income. I'm not going to go too much into taxes in this episode, but it's important to note. So if I made $100K and let's say I'm taxed 33%, meaning that I would actually pay $33,000 in taxes. If I contribute $6,500 to an IRA, then I can say that my actual income was $93,500. So I only pay taxes on that, save some money. But what's arguably cooler, in my opinion, and what I personally contribute to, is what's called a Roth IRA. A Roth IRA is post-tax, meaning you can't do that tax thing I just mentioned, but it grows tax-free. So every dollar that is made in that account, you can take out after you're 59 and a half completely tax-free, which means if I continue to contribute as much as I'm contributing right now to my Roth IRA, I will literally have multiple millions of dollars that I can take out completely tax-free from my Roth IRA. There is a maximum income that you can contribute to a Roth IRA, which is around like $150 thousand this year, I think. Anyways, I'm above that. But then there are ways to get around it. There's a strategy called the backdoor Roth IRA, which is essentially contributing to a traditional IRA and then converting to a Roth IRA. If you don't make above $150,000 a year, you don't have to worry about this. But if you do, that's something to look up. It's called backdoor Roth IRA. So those are the retirement accounts, right, that a lot of people do. And it's important to note that once you put money into one of these accounts, right, once you opened them up in Fidelity or whatever, you actually need to invest the money, right? An IRA is just the type of account, but you actually still need to invest the money once it's in that account. And that's where it comes, the decisions of individual mutual funds, those types of things that I talked about previously. That's where that comes in. But don't just leave it sitting in an account. There's a lot of people who will open up a Roth IRA, fund it, and then not invest the money. And then it just sits there and you get no benefit. I want to talk about one thing that's a bit advanced, which is a HSA, which is a health savings account, which is for people who are on a high deductible health plan. So this is health insurance, right? If you are on a high deductible health plan, then you can contribute to a health savings account. This is what I personally do, which has a maximum contribution limit of $3,800, I think, in 2023. And you can actually invest the money in there, which is really interesting. So what I do is I invest the money in my HSA, which essentially becomes another retirement account because it grows tax-free as well. And you have to use it for medical expenses up until a certain age, but then you can actually pull it out and use it for whatever. But that's a bit more advanced. You can look it up, contributing and investing in HSA. The last and arguably most common type of account is just a taxable brokerage account. This is when you just go to an account and say, hey, let me open up an investment account. And what this is it's an account where you can send money however much you want, whenever you want, and invest in whatever you want. But any money that you make in that account is taxable. Meaning, if I buy a stock for $1,000, it goes up to $2,000 and I sell, meaning I made $1,000, I would have to pay capital gains, which is the type of income on those $1,000. And there's a difference between short-term capital gains and long-term capital gains. Short-term capital gains is when you have a holding for less than a year. So if I bought that stock and sold it in under a year. Long-term capital gains is if I held it for over a year, and then the tax rate is much, much, much lower. This is something to focus on, especially if you are thinking about buying and selling stuff fairly quickly. But again, if you're just thinking about buying and holding for many, many years, then you'll really only have to worry about the taxes once you start selling out of your positions. Really quickly, if you're enjoying the video on personal finance, please make sure to like, subscribe, and leave a comment down below of what you'd like me to talk about next. As always, let's get back into the episode. There's a bunch of other type of investments. You can invest in real estate. You can invest in physical assets like gold or silver. I personally don't invest in those things, which is why I spent so much time talking about stocks. But I want to make a side here because I think that a lot of my audience is young. And there was a really big thing that happened in the past couple of years, which was cryptocurrency and NFTs, right? These are what I would call hyper risky investments. And in general, risky investments like these should not be more than 10% of your portfolio. That's at least what I hold myself to. And so a lot of people are so deep in crypto, 50, 60, 70% of their entire investments are in crypto. And then as we've seen, stuff can crash and go to zero. And so yes, those sort of speculative investments, feel free to play around with them. I try to keep it around 5 to 10% of my entire portfolio. And I never invested in NFTs, right? That I saw that they weren't really valuable. Turned out they weren't. And so, yeah, just pay attention to those things. That's enough about investing. I want to switch and talk more about debt, right? A lot of Americans are in debt, and there's so many different types of debt. And I think so many people just go into debt and don't really think about it. They don't know what they're really getting themselves into. So I want to talk about that for a little bit. Firstly, and the most popular type is just credit cards, right? Credit cards are one of the worst things maybe to most Americans. They're a great thing for some people like me. I use them as a tool. So I want to talk about, like, should you use a credit card? Should you open a credit card? What do credit cards do? Americans are literally over $1 trillion of credit card debt right now. The average person is in a credit card debt of north of $5,000, right? Think of how much money that is of you owing that to somebody. And interest rates on credit cards, this is what you need to understand. Interest rates on credit cards are insane. This is you paying them interest. So if I buy $1,000 worth of stuff, and my credit card has a 30% interest rate, and I don't pay them back the $1,000, the first month, I now owe them $1,300. Think about that. That's insane. $300 I just lost. And so, or sorry, not next month. It's an annual interest rate, but it's still absurd. And so, in my opinion, you should not be getting a credit card, period, if you plan on ever holding a balance, meaning that you do not plan on paying the full amount that you borrowed each month, pay it each month. If I spend $1,000, I pay $1,000 in the same month. And so many people will use it as sort of like a loan. This is not a loan because the interest rates are so absurd that you need to treat it almost like a debit card. I don't treat it of, I don't have the money now. I'm going to get the money, so I'm going to pay it and then pay it later. No, I do not buy anything that I could not buy immediately in cash. And when I say cash, I don't mean physically, but like liquid, if that makes sense. And so many people take out so much credit card debt. Oh, I want a new TV and I'm furnishing my new place, and get into so much credit card debt. Or they'll start spending it because they think, the points, right? So I want to talk about like points. The points and the benefits that you get on credit cards are so insignificant if you hold any debt that it's not worth it, right? There is no equivalent to be like, I'm in $400 in debt to this credit card, but I get 4 times point on gas. The 4 times point is screwing you over, right? The interest is so high that it's just screwing you over. Yes, they can be very cool. For example, I have like 5, 6 credit cards now maybe. And sometimes I get to travel for free. Sometimes I get free stuff online. I can, get a lot more points back, a lot more miles back when I travel. I get access into the private lounges at airports and stuff like that. That's all really cool. But that's because I'm a responsible credit card holder and I pay my balance off every month. Some important notes about credit cards, because I think that people think, I have to get a credit card to improve my credit score. It is true that you need credit history to improve your credit score, but there are things that will negatively affect your credit score. If you are spending above 30% of the credit line, meaning if they say you can spend up to $3,000 a month, if I spend over $1,000 of that, it'll actually start to negatively affect your credit score. So just getting a credit card and spending as much as you want is not actually good for your credit. Similarly, the length of time you've held a credit card is also important. And so the longest line of credit actually affects your credit score. And then the number of credit checks, but I'm not going to go into that here. There's a lot of things that go into your credit score. You can do that research on your own. But why is it important to have a good credit score? Well, because people use that as a way to see how reliable of a borrower are you. And so when you go to buy a house or to buy a car, then you will have lower interest rates the better credit score you are, meaning they will make you pay less because they see you as less risky. So it is important to build credit. There's a lot of credit cards out there, by the way, where there's no annual fee and it actually treats it more like a credit card or more like a debit card than a credit card. Those are great for people who aren't responsible credit card users but still want to build credit. If you're wondering about my personal favorite credit cards, by the way, I use the Amex Platinum. I think that's what gives me the lounge access. That's what gives me a lot of points on flights. I also get an Uber credit and a bunch of other cool things that I personally like about having the Amex Platinum card. And then the other one is just the Amazon Chase card. I get 5% back on all purchases on Amazon, and I buy a lot of my stuff on Amazon. And so that's another great card. But again, if you're someone who will spend more because you get the points, then maybe you're not a credit card person. I'm someone who it's a benefit when I'm spending anyways. Another big type of debt that I see a lot of Americans go into is obviously a car loan, right? One of the biggest taxes just on America in general is that you have to buy a car. A lot of cities are basically requiring you to have a car, which I'll go into later. I actually personally don't own a car, but that's because I live in one of the very few cities where I don't need one. But most people will have to have a car to commute to and from work, drop kids off, blah, blah, blah. You don't need a new car. I don't care what ads you see. I don't care who you're trying to impress. You do not need a new car. As soon as you drive a car off the lot, it loses about 30% of its value, right? Buy a used car. You can buy a used car. I promise you that it'll run fine as long as if you buy like a really, really cheap car, then obviously get it to a mechanic, make sure that it's safe to drive. But in general, you don't need a new car, nor do you need even a really fancy car. I think a lot of people buy a car that's way, way, way nicer than they can actually afford because they try and impress people. They want to signal that they have wealth. I would be happy to drive a little rinky-dink car if I have one. And when I get one, I might as well buy something that's a little cheapo because I know that my car isn't a symbol of worth as me as a person. There's this thing called the man in the car paradox, which is, when you see somebody driving a Ferrari, somebody pulls up in a Ferrari and you go, wow, like I would love to be that guy, right? I would love to be in the car and be driving that Ferrari because then everyone would think I'm cool. But you aren't thinking about the guy who's actually driving the car. You aren't saying, wow, he's cool, he drives a Ferrari. You're imagining yourself in the Ferrari. So if you're not thinking he's cool, then nobody would think you're cool, right? Nobody really they just like it because they imagine themselves in that situation, but you don't actually get really the social status that you think you do from owning, for example, a supercar. And this goes for not, by the way, just supercars. If you can't afford a Mercedes, don't get a Mercedes, right? Get a Honda, get a Toyota. And a lot of people don't really understand interest rates. So they'll get a super high interest rate for a super long loan length for a car, right? I personally would never take a loan over 3 years on a car. I want to pay it off quickly because of depreciating value and stuff like that. And the longer that a loan is, the more you pay in interest, right? So you can do the math. There's a lot of calculators, but basically if I have the longer that a term is on a loan, the more money you're paying than what the thing was actually worth if you could have bought it on day zero in full. Something to note. I don't think a lot of people understand that. Student loans is another really, really big issue for Americans. I think student loans are also over $1 trillion now across all Americans. For people who have student loans, there's a couple things I can give you advice on, but I'm going to be speaking to the people who don't even have student loans yet for a second. I personally have no student loans. By the way, I'm immensely privileged. I'm immensely grateful that my parents saved up money to pay my in-state tuition at Georgia Tech. I, again, cannot speak on how grateful I am and how privileged I am to have that. I will do the same for my kids. However, speaking to people, because I know that many people aren't in my situation, if you are going to take out student loans, right? If you're going to go to an expensive college, you need to have a plan on how you're going to pay those back. You cannot say, oh, but I'm just really passionate about dance or trumpet, so I'm going to go take out $60K a year and I'll worry about that later. I'll be the 1.01% of people who make money in those things and I'll pay it down. No, that's irresponsible. You can literally go into $240,000, if not more, of debt for something that you may never be able to pay back. Do not do that. I don't care if you're 18, 16, 17. I'm talking to you and I'm talking to parents too, because they enable this. You need to have a plan to pay it back. And what's unfortunate about that is it might limit what you're able to study. There's a couple fields, there's a couple majors that have a really good return on investment. Computer science, engineering, if you're pre-med, pre-law, finance, accounting, right? Those generally have a good return on investment. A lot of other majors don't. And so if you're going to take out student loans to pay for your education and then graduate and realize, oh, the jobs aren't paying that much, or it's very hard to get a job in this field, then that was you being irresponsible and not doing due diligence. Now, if you get a scholarship, go for it. Study whatever you want. If your parents can afford it, go study whatever you want, right? But for people who can literally ruin their life from the amount of debt that they would take, do the due diligence. Figure out if you can make money. Don't take private student loans unless you really have to as well. Private student loans are people trying to make money off of you. Obviously, the government, when we talk about private versus federal student loans are generally at a lower interest rate, meaning you'll pay less. And when stuff happened, like when COVID happened and they paused student loan rates, private institutions didn't have to do that. So while everybody else wasn't having interest accruing, some private student loans were still accruing interest. So that's, again, when it's a company versus the government generally does have a bit better of your intentions in mind. Maybe not always, but in this case they do. So if you can get federal student loans, do that as opposed to private. If your interest rate is higher than 7%, which is not going to be for most student loans. Most student loans are like 3% or more, or lower. But if your interest rate is higher than 7% for whatever reason, this goes for any loan, actually, by the way, any kind of debt. The average rate of return in the stock market is 7% with dividends not reinvested, right? So just assume 7%. So if your debt has a higher interest rate than 7%, what that means is if you put money in the stock market instead of paying down your debt is growing faster than whatever money you would make in the stock market. Meaning you would be better off getting rid of the debt first and then investing. But if your student loans are, say, 3%, then you can pay the minimum monthly payments and actually make more money by investing in the stock market, because the difference of growing at 7% versus going at 3% means that you would be better off investing. Although a lot of people, I will say that it sort of like from a mental health perspective, it might be better for you to get rid of all debt. To say that you're debt free feels amazing. So maybe you'd prefer that and then start investing. That's up to you. Another thing about student loans is that they stick through bankruptcy. So credit cards, you can get into hundreds of thousands of credit card debt, and then it can be forgiven by going through bankruptcy, which I'm not recommending at all. But student loans, you can't even get rid of through bankruptcy. So they're stuck to you for life. So that's another reason why you have to be very careful about the student loans you take out. That's enough about debt. I want to talk about saving, right? Saving money. In general, I think that you should try and save as much as possible. I think that a lot of people don't have what I would call an emergency fund, right? This is a very common concept in the financial world, but you should have money on hand in case of an emergency. And in general, I have, for example, a 6-month emergency fund, meaning if all of a sudden I got fired from my job, or I got injured and I was unable to work, or even, something happens to my house, or one of my, my computer just breaks, right? I have enough money on hand that I could, without going into debt, just cash flow that. And so it sucks to have just a pile of money sitting on the side, not doing anything, but it's much better for the peace of mind that, hey, if, there's some crazy stat, like 40% of Americans wouldn't be ready to take on a $400 surprise expense. $400 might be like you blow 2 tires. That's fairly common. Your engine breaks, right? Pretty common. Your computer breaks and you need it for work. That's another one, right? There are so many things that would cost $400, and yet people don't have that on hand. And so, and especially for me, I work in tech, right? Layoffs are common. So I need to be ready in case I, for example, lose my job tomorrow. And that's why I have a 6-month emergency fund. And when I said that money is just sitting on the side and not doing anything for you, what's really interesting right now is that interest rates from the Fed are very, very high. You've probably heard about this. Oh, Jerome Powell raising interest rates. And if you haven't, it's in the news. But essentially, they can set the return on what are called bonds. Bonds are essentially a loan between you and the government that gives you a guaranteed rate of return. So it could be like a 1-year treasury, a 2-year treasury, a 5-year treasury, a 10-year treasury. And those will have different yields, meaning they will pay you a different amount for saying, hey, thanks for giving us your money for a little bit. This is their tool to fight inflation, by the way. But when those are really high, what that means is that everyone's probably heard about high yield savings account recently. I personally put my money in what's called a money market fund, but it's similar to a high yield savings account, and that I'm getting roughly 5% on my savings. So my emergency fund is sitting in an account, but it's making 5% right now, which again, I said that the stock market has on average made 7% a year. So only 2% less, and it is guaranteed. The stock market could go up, down, who knows, but 5% is guaranteed. So my emergency fund is actually generating me a decent amount of money right now. So that's another reason why I think that you should, or why me having an emergency fund right now, I'm actually not too worried about it. And I'm not too worried about having a lot of cash on hand right now. The other thing I want to talk about is just like general smart money habits. These are things that I've built over time that I didn't maybe used to do, but do now that maybe you could try and adopt as well. And the first one is that I just live well below my means, right? I'm in the top 1% of earners for my age, and yet I live like a broke college student. And that's kind of a joke, but I live in San Francisco and I live with 2 other roommates in a 3-bed, 1.5 bath apartment, which means that my rent in San Francisco is $1,500, which is actually really good. And maybe on a global scale, that's still really expensive. But in San Francisco, that's absurd, $1,500 rent, which is less than 20% of my take-home income. There are people out there, the recommendation is, by the way, like 33%. It should be under 33%. Some people are spending 50% or more on their rent alone. And some people, they don't make enough. So I'm not saying that that's a one size fits all rule, but I'm saying there are people out there who make good money and then still live very close to their means. And so they feel broke despite making a lot of money. And something like a third of people making over $200,000 a year say that they're living paycheck to paycheck. That is absurd to me. That is absurd. And if you're taking care of a family, that's another thing. But I'm a single, I only have to take care of myself. And so I live well below my means. I live like a broke college student. And I don't spend my money on useless stuff, right? There's the concept of lifestyle creep, which means as you make more money, you start to spend more and more. I don't do that. So there are things that I refuse to spend my money on. I refuse to spend my money on Grubhub, Uber Eats, DoorDash, any kind of meal delivery service. You're oftentimes paying close to double what you would pay if you would just go into the establishment. I don't even have a car and I don't pay for these things. Yes, the convenience is nice, but a lot of people can't afford this stuff. And then they're Uber Eatsing McDonald's and it costs $50 to Uber Eats McDonald's. Ridiculous to me. Refuse to do it. The second one is designer clothing. I see it kind of like as the man in the car paradox, but I have never looked at somebody in Gucci, Versace and thought, wow, they're rich. The largest consumer of designer clothes are actually the middle class and oftentimes people who can't afford it. And so people will say, oh, they're higher quality. They're not higher quality. It's forced scarcity. And so it really is not higher quality. You do not need Gucci, Louis Vuitton, all these things, Versace. I refuse to buy them. I think they look tacky. And so I buy like normal clothes, just stuff that I like that fits me well. Not name brand, or sometimes I'll buy name brand stuff, but not, $400 for a t-shirt. I also refuse to do any kind of buy now, pay later program. There are things like Klarna, Afterpay, these things where you can basically create monthly installments. Even if it's 0% interest online, people will essentially go into debt to buy like dog food, which is ridiculous to me. And when I say go into debt, that just means that you owe money over time to someone as opposed to just buying it outright. And so just buy it. If you can't afford it in full, in cash, on like when you're shopping online, then don't buy it, right? Don't do the 4 installments of $19.99 with 0 interest. I just refuse to do it. I also don't have a car, which I mentioned, which is just great, right? I could live in a city where I don't require one. And so that saves me so much money. No car payment. Imagine if you had no car payment, no insurance, right? It's such a peace of mind. I don't have to worry about parking. And so yeah, that's just another thing that I don't have. Another thing that I do money habits wise is I track literally all of my expenses. I know every cent that is coming in and out of my account. And that helps me budget things because I don't actually have a budget, but I see where I'm spending all my money. If you're wondering how I track it, by the way, in my link with all my socials, I have my own expenses tracker that I created with steps on how to create it. But essentially it's just a little Google form, Google sheet. And that way I can categorize everything. So I see, I spent this much on essential stuff, this much on food, this much on, clothes and everything like that. And it makes me spend less, but also it gives me a really good idea of my burn rate. This has become even more important now that I started making money from social media because I need to know what's like a business expense and what's not. But even before that, tracking all my expenses, a lot of people don't even know how they're going into debt. They don't know where all their money's going. So if you have no idea, if you wake up and you're like, oh, my entire paycheck is gone and I don't even know how, start tracking your expenses, see where all that money's going. It's really important. The other thing is generally just teaching myself financial literacy. I mentioned that 3 years ago, I was basically financially illiterate. I didn't know anything. I didn't know how to invest in stocks. I didn't know, all of these different types of accounts. I didn't know best practices for credit cards or loans or debt. I taught this all myself by just online free resources. I didn't take a course. And so I tried to congregate a lot of that here, but point being, it seems complicated, right? There is an initial hump of going from nothing to learning something, and then sort of, because you don't know what you don't know, right? So start doing that research on your own. Your future self will thank you so much. I wish it was taught in schools, but it's not. There are a couple of things that I didn't cover in this episode as I begin to wrap up. I didn't really cover any kind of like real estate investments, just because I personally haven't done that yet. I'm looking into it and I want to do it, but I don't know much about mortgages and down payments and best ways to invest in real estate. I'm learning, don't know much about it. All of this is just in my head from personal experience. Haven't done that yet. The other one is like taxes. In general, pay your taxes, right? For a lot of people, if you're a W-2 earner, meaning that you just work at a company that pays you a salary, then they'll just take your taxes out of your paycheck. So you don't really have to think about it. It just goes off to the government. But if you do any kind of contracting work, then you need to set aside money for taxes, because the IRS knows what money you're bringing in. And so you'll have to pay those taxes. And there are a lot of ways to reduce your tax burden through real estate or through business expenses, so on and so forth. Didn't cover that in this episode. However, there's many other personal financial YouTubers who cover that way better than I ever could. If you're wondering what I'm like the future for me, right? What am I doing with my money? What's going on? My net worth is now over $100,000, which is awesome at 23 years old. That's not something many 23-year-olds can say. Again, incredibly privileged, but I did make all that money myself. I just happened to be zero debt, which is a great starting point. But I'm going to continue to make more money from my social media. I'm starting to make a decent amount from that and scale that business. So a lot of people, when I talk about my software engineering income, they'll be, oh, you're in the matrix, you're 9 to 5. I'm starting to make decent money from, my social media. And so when I go to bed and wake up in the morning, I've made a little bit of money. So continue to scale that and continue to invest that in smart ways. In my W-2 job, I'm planning on getting promoted or getting a raise. So I'll continue to make more money in that, as well as just, I'm going to continue to live below my means. And so that even when I get those raises and I start making more and more money, I'm still going to have more and more money to invest, which means I'll be able to retire even earlier. I want to get into real estate. That's one thing I just mentioned. So I'm looking to invest in stuff in the future in the next couple of years here, which will be super cool. And if I do all these things, I'm going to become rich, right? It's not a matter of if, it's a matter of when. And so being smart with your money is so huge, right? You might have an income problem and then you should work on getting your income up. But a lot of people, again, make $500,000 and spend $490,000 a year. Those people aren't going to become wealthy ever. As always, thank you guys so much for watching. I'm going to wrap this up really quickly, but thank you guys so much for watching this episode. Leave a comment down below if you learned something new. What did I teach you about today? What would you like for me to talk about next? And make sure to like and subscribe, as it really helps me out as I'm trying to grow this channel. And if you're on any podcast platform, please give me 5 stars. As always, thank you guys so much for watching, and I'll see you in the next one.